Right. Assalamualaikum warahmatullahi wabarakatuh. And good day. All right. Um, I just want to finish up the slide. Just I think we stopped our slide for accounting for lessee only. All right. So now we proceed with accounting by lessor. All right. So as you can see from the slide, accounting by lessor. The slide is not that much. Okay, most of MFRS 16 that we learn, we are focusing on accounting by lessee, right? Okay, but never mind, we proceed. Okay, so accounting by lessor. All right, again, we know lessor is the owner of the asset, right? Is the original owner of the asset that give the right to use of that asset to the lessee. Okay, again, lessor is the owner of the asset. All right. So in this slide, they mention continue to apply lessor accounting model in MFRS 117, which is a risk and reward model. In other words, actually, for accounting by lessor, there is no difference between MFRS 16 and MFRS 117. The previous one before MFRS 16 take over the MFRS 117. In other words, the treatment is similar. Alright, okay. So it is based on risk and reward model. What does it mean by risk and reward model? We see who control the risk and reward, who obtain the most risk and reward. Is it lessor or is it lessee? Why do we have to determine this? Because we have to decide under M5117, we have to decide whether it is a finance lease or operating lease. Alright, okay. So the lessor shall classify the lease arrangement as operating lease or finance lease. Alright, as mentioned under MFRS 117, we have to determine whether the lease is finance or operating. Alright. So the lease is classified as finance lease if it transfer substantially all risk and reward incidental to ownership of underlying asset. Otherwise, a lease classified as operating lease. In other words, actually, if lease and reward, lessor is the owner of the asset, lease and reward transfer to lessee, then it is finance lease. Or else, if the risk and reward still maintained at lessor, then it is a operating lease. Okay. Upon lease commencement, a lessor shall recognize asset held under a finance lease as receivable at an amount equal to the net investment in the lease. Alright. This one is only applied to finance lease. If it is finance lease, that's why we have to decide. If it is finance lease, then lessor have to recognize a receivable at amount equal to the net investment in the lease. If it is operating lease, no need. All right. So lessor recognize a finance income over the lease term of the finance lease based on the pattern reflecting a constant periodic rate of return on the net investment. All right. So at the commencement date, a manufacturer of the dealer lessor recognize the selling profit and loss in accordance with the policy outright uh, sales. Again, I don't know how to move this. I'm sorry. Okay. Lessor recognize operating lease payment as income. All right. So if it is operating lease, it is recognized as rental income. All right. On the straight line basis, or if more representative, the pattern which benefit the use of the underlying asset is diminished, another systematic basis. Alright, so the to recognize under finance lease is either a straight line basis or systematic basis. Alright, so we proceed. This is example of finance lease. And first we go to example of finance lease. So example of situation that individually or in combination would normally lead to lease being classified as finance lease are alright. So this is a lease transfer ownership of the asset to the lessee at the end of the lease term. This one is very common. At the end, the asset is belong to who? Lessor or lessee? If it is lessee, then it is finance lease because definitely there is in what transfer to lessee, right? The lessee has option to purchase the asset at the price which are expected to be sufficiently lower then the fair value of the date of auction become exercisable land. So because the price is lower than the fair value, it is reasonably assumed that the lessee will purchase, right? Because the price is lower, right? Okay. The lease term is for major part of the economic life of the asset, even if the title is not transferred. The lease term mean that the asset can be used for 6 years. You lease for 5 years, for example. And so the major term. At the inception of the lease, the present value of the minimum lease payment amount to at least substantially all the fair value of the lease asset. Minimum lease payment is equal to fair value. The lease asset are of a specialized in nature that the lessee can use them without major modification of being made. It is specialized for lessee only. Other company do not want to use it. This one is specific, like for example, what TNB, like for example, TNB in Malaysia, the energy provider in Malaysia only want TNB, right? So if the asset is designed for TNB, it cannot be used by another firm because another firm did not supply energy to other, right? So this include if the lessee cancel the lease, lessor losses associated uh, with the cancellation are borne by lessee. Okay, lessee cancel the lease. Remember we do the penalties. One information about the penalties, right? Right. So the gain or loss fluctuating from the fair value of accrue from the lessee, and the lessee has ability to continue the lease for the secondary period, which is the price is lower than the market, right? Right, yes. So we go to this example, okay. So you can see here, NTTT, a software training company, arranged with a computer distributor to use a 10 laptop computer for training service to its customer. All right, you see, arranged with a customer distributor to use 10 unit of laptop computer for training service to its customer. Okay, for financing the purchase of the computer, and they arrange with a leasing company that pay 30,000 directly to the supplier. Okay, you see, entity arranged with a leasing company that paid 30,000 directly to the supplier. Okay, the lease is for 5 years with yearly installment of 7,200 at the end of each year. Okay, 7,200 payable at the end of each year. Right. So again, guys, so the payment is in the beginning or in the end? In the end, the question mentioned in the end, right? But this is from the perspective of what I saw. So for this part, actually, they pay 30,000 directly to the supplier to have this asset, and then they lease the asset to the third party, to the customer. All right. So this is for the company. And indefinite secondary lease payment after the fifth year at the nominal rent of 1 ringgit. 1 ringgit is included in the contract to legalize it as finance lease, but will not be collected. This sentence, just to make sure that the asset is still there in the company, and it's not disposed, because the asset is not disposed, must have there in the company, so the value is 1 ringgit. All right, okay. So the interest rate is 6.4%. You see, the first one, at the commencement date, the leasing company, which is lessor, record as debit lease receivable, which is the total amount that they will receive, 7,200 times with 5 years, right? Okay, the total amount that they will receive. Okay, they will receive, not yet receive, will receive. That's why the name is lease receive verbal. Will receive but not yet receive. Receive verbal. Okay, so lease receivable is 36,000. How much that the company pay to acquire the asset? Cash 30,000 here. All right. So by right, the company are going to have an income by how much? 6,000. This income, the company earn or not yet earn? Not yet. Okay, not yet, because this income is earned from the leasing. Okay, from the leasing. When the leasing is happen, then the income can be earned. How much earned per year? Depends on the interest rate per year. Okay, again, I repeat. Again, in this first journal entry, lease receivable is the total that going to be received by lessor but not yet received. So it is a lease receivable. Okay, so 7,200 times with 5 is 36,000. Okay, how much the company pay to acquire the asset? 30,000. So 30,000 cash to acquire the asset, 30,000, Alright. So, how much the company will earn in the perspective of income, will earn, not yet earn, will earn 6,000. How to get this 6,000? 36 less with 30 equal to 6,000. Okay, so this 6,000 can we record as income? Not yet, because it is not yet earned. Remember, income can be recorded when we earn only. Expenses can be recorded when we incurred only. Okay, not when we pay and everything. All right. So now income is not yet earned. So that's why we categorize this as unearned income. Finance income is what? Interest, right? Interest received. Unearned interest received or unearned finance income. Okay, not yet earned. So we cannot recognize this as our income yet. So guys, unearned finance income is categorized as one. It is not income. Therefore, it is categorized under one. We have asset, expenses, liability, equity, or revenue, right? So it's not revenue. So it is categorized under one. Why it is on credit side? If it is not revenue, it is unearned. Okay, unearned income mean that cash you receive, but the cash you receive, but the income cannot be earned yet. In this case, actually, receivable you record already, but you cannot recognize the income yet. Okay, so therefore, this unearned income is part of liability. Why it is liability? Because the company are going need to give or need to make sure the product is there for the customer. It is obligation for the company to make sure the product is there for the customer, for the company to earn the income. So it is obligation because this part of the obligation, so it is categorized as a liability. Unearned finance income, unearned interest income or unearned finance income. Actually, this is the concept of accrual. This is the concept of accrual. Remember, accrual, we have a prepaid expense, we have a prepaid revenue. Actually, revenue is not called as prepaid because revenue is not we paid, we receive. So that's why revenue, prepaid revenue is categorized as unearned revenue or unearned income. Okay, so prepaid expense, we pay in advance. Prepaid expense, we pay in advance, prepaid expense, we receive, we provide expenses in advance, so it's our asset. Because in future, no need for us to pay, right? However, contra to prepaid expense, prepaid revenue or unearned revenue, because it's contra, prepaid expense is asset, prepaid revenue is liability. Okay, prepaid revenue is from the perspective of revenue we should receive. In this case, we receive in advance because we recognize the lease like a receivable. This receivable, inside this receivable include the revenue. So we recognize this revenue. We have this revenue in our record, but we cannot recognize yet as our income. We cannot recognize yet in our income. Why you cannot recognize yet in our income? Okay, because actually we haven't received the payment of a rental, right? We haven't received yet, right? So that's why we cannot recognize as income. When do we recognize as income? When we receive the payment, then we recognize as income. All right. Okay. So you see the next at the end of year one. Okay. At the end of year one, what does it mean? Mean that the first payment at the end of each year, right? So the first payment. The first payment, how much? The first payment is 7,200 per year, right? 7,200. So debit cash, we receive, right? So debit cash, 7,200. And our receivable is decreased by 7,200. Okay. Receivable is asset, decrease on credit side. Okay, then how much the interest that we receive here? Interest income. Interest income we receive is 30,000 times with 0.64. 30,000 is what? 30,000 is the amount that we have now. Okay, you see the amount that we have now, amount that we pay now, the value of the asset now, we need to increase the value until it becomes 36,000 at the end, right? So the asset value will increase, but not the asset value. Now we increase from the perspective of interest. All right, you see, debit unearned finance income. Why debit unearned finance income? Because now part of this finance income we earn already. So we earn already. We take from unearned, we put into the one that we earn. If we earn, we can recognize as our income or revenue in our statement of profit or loss. How much we earn now? We earn only 0.64% out of 30,000. So we earn only 1,920.67. Again, just round off, you are going to get 1,921. All right. So here, if you're not understand yet, you can see this table. Okay, you can see this table. If you're not understand yet, you can see this table. Right. So in this table, actually, you can see we start with 30,000. Why 30,000? Because this is what we owe. I mean, this is the obligation that we have, 30,000, right? Okay. This is the cash that we paid, the 30,000, right? The amount that we paid. Okay, 30,000, It's not lease receivable, This amount, the amount that we pay, 30,000. See, amount that we paid is 30,000. Okay. The calculation of interest, 6.4% times 30,000. This one is similar with the lease liability, but the amount you take is the amount of your asset. I mean, the amount of the one that you pay. Okay. So you get 1,920. The lease payment is equal, right? 7,200 for 5. 1, 2, 3, 4, 5. You see, You plus interest minus lease payment, then you get the closing balance. Closing balance for year 1 going to become beginning balance for year 2. Again, calculate again the interest, 6.4% times your opening balance. Again, plus interest, less payment, and you get a closing balance. Until the end, you are going to get 0. You see, total interest income must be 30,000. This is the total interest income that you have, which is actually 30 plus 6,000 equal to 36,000, a total payment that you are going to receive, basically. This is from the perspective of finance lease and under lessor. This is from the perspective of finance lease and the lessor. So if the question asks you, how much interest that you are receive next year, how much interest that you are going to receive next year? This one, this figure, 1,582. How much interest that you are going to receive in you can earn or you can record as interest income in year 4, 840,038. Right. So this is how you record the interest. Remember the concept, unearned interest and interest earned. Okay, that one is different concept. Unearned is the one that you haven't earned yet. Therefore, you cannot recognize as an revenue. When you earn, then you recognize as revenue. When do you earn? When the payment is made, when the timeline is finished after end of the year, then you earn already the interest that you should receive. All right. Okay. That one is under finance lease. If it is under operating lease, basically operating lease is much more easier. Okay. A lessor will recognize lease payment from the operating lease as income on either a straight line basis or systematic basis. All right. A lessor shall apply on a systematic basis if that basis is more representative of the pattern which benefit from the use of underlying asset is diminished. All right, never mind. So example here, we can see entity M rent a building to a customer for a lease term 10 years. The rental payment is fixed at 5 million per year for the first 5 years and 7 million for the next 5 years. All right, entity M expect the customer to consumption or use it for over 10 years period, right? So the total rental is 60 million on the straight line basis. The rental income is 6 million. Straight line basis, straight line basis. Rental income is 6 years. 6 million. Why 6 million? This one is the average that the company are going to receive. 5 million for the first 5 years and 7 million for another 5 years, right? So basically, 5 times 5, 7 times 5, total up, divide by 10, you are going to get 6 million because total rental is 60 million. You see, 5 million times with 5 years is 25 million, right? 7 million times with 5 years is 35 million, right? So 25 plus with 35, you are going to get a total rental of 60 million. 60 million divided by 10 years, you are going to get 6 million per year. That's why the question mentioned here, straight line basis, rental income per year is 6 million. So in this case, actually, okay, this is happen only if this situation is happen. If this situation is happen, mean that The first 5 years is 5 million, the next 5 years is 7 million. So you have to do this. If for the rest of the year, all 10 years is 5 million, then easy lah, right? Easy. So debit cash, credit rental income only you do. This one only you do if the first 5 years different, the next 5 years is different. Right. So now how to record the 6 million? You see, the first 5 years, you only receive 5 million. So how to record the 6 million? You see, rental income is 6 million because you do a straight line method here. And debit cash, 5 million, the one that you receive. Accrued rental is 1 million. Okay? Right. However, in the next 5 years, so in next 5 years, this accrued rent is equal to 5 million already, right? Because it's after 5 years, right? So you see, you are going to write down this accrued rental by 1 million per year for 5 years. So cash you receive is 7 million, but rental income is only 6 million. You can recognize because the straight line method, and the cash you receive is 7 million. So therefore, the accrued or the balancing figure is 1 million. Therefore, this 1 million are going to transfer to here until it is 0. Accrued rent is accrued rental income. Accrued income is income that you should receive but not yet receive, right? So therefore, you see, accrued rent is categorized as your current asset or asset, all right? Because you are going to receive in future. That's why it is debit side increase. When you recognize, you put on debit side increase. But when you de-recognize, you put on credit side decrease because this asset, right? So the next part is sales and leaseback. Sales and leaseback is actually involve the sales of an asset by the owner and simultaneously leasing the same asset back to the owner. Okay, remember the situation like this. I have a building. I sell the building to Ahmad. And after that, I lease the building. You see, something fishy around here, right? I have a building. I sell the building to Ahmad. But I lease the building after that. Something fishy, right? Is it the actual sales and leaseback? Is it the actual situation is I sell the building, then I realize, oh, I need to use the building, so then I lease the building. Or is it the situation, actually, I sell the building and then I lease back the building because I want to obtain a loan from Ahmad? Is it, which situation is that actually? So that is sales and lease back issue actually. All right. The owner of the asset will transfer the buyer or lessor, and original owner become the lessee after the lease back. And then part 16, the accounting for such transaction depends on whether the transfer of asset is a sales or not sales, rather than the nature of the lease back. Okay. If the buyer lessor has a control of the asset, transfer is sales transaction. It is depends. If I sell the building should be belong to the lessor. I mean the one who buy the building, right? The buyer. If I sell the building to Ahmad, Ahmad is the one who control the building. Should be like that because that is the sales transaction, right? If the seller or lessee retain the control, have the ability to direct the use, obtain substantially all the remaining benefit of the asset, transfer is not sales transaction. Imagine if I sell the building to Ahmad, but I still have the full control of that building. Ahmad is not full control of the building because let's say I sell the building to Ahmad and then I lease back the building, right? So I still have the full control of the building through the sale. Ahmad not control the building at all. So is it sales and lease back? No, that one is not a sales and lease back. That one is basically only loan or financing option. You see, this is the tactic, right? This is the tactic. I want to borrow from Ahmad actually, but I don't have enough cash. Sorry, I don't have um enough credit rating. My credit rating is not nice, but I want to borrow from Ahmad. So what do I do? I have a tactic. I sell the building to Ahmad at 100,000, and then I lease back the building. The total lease I'm going to pay to Ahmad is 120,000. So Ahmad are going to earn 20,000, right? It is similar like loan, right? 20,000 is the interest that Ahmad charge, right? So it is similar to loan, but it is record as sales and leaseback. Why sales and leaseback? Why not I just borrow from Ahmad? Because I don't want to show in my account that I have a liability or loan from Ahmad. If sales and leaseback, I sales, and then I lease back, lease liability, not a loan. So when I go to bank and next bank, I show, oh, I don't have loan lah. I have this liability because I lease only. So you see, I can tell, I can inform bank that I don't have loan. But is it actually that happen? The one is actually depends on the control of the asset. Who the one who decide this? Company need to be honest to decide this, and auditor need to check whether the company is really honest in recording this. All right, that one is sales and leaseback. Right. So determine the transfer of asset is accounted for sale of identity apply require under IFRS 15. IFRS 15 is actually the what? The revenue from the contract of the customer. Okay, this one is the revenue contract of the customer. If the asset is transferred satisfy 11,550 requirement, then it is a sales. So it is sale, we record the sales or disposal, then we lease back, we record a lease back, which is we record a right of use asset. If it is not, then it is just a loan. Okay. All right. So this one is the last slide, right? Last information for you. Sub sales. Sorry, sublease. What is sublease? Okay, sublease is transaction which lessee, okay, or immediate lessor grant a right to use underlying asset to the third party. I think someone asked me this, right? So this person, this is the owner of the asset, owner lease to this person. So this B is a lessee. B use part of this only. So B lease to the third party. So this is what it means by sublease. Sublease. The middle person here is actually immediate lessor or lessee at the same time. The middle person here is actually lessee and lessor at the same time. Okay, the company apply for 16 to all these of ROU. So how to record this? From the book of this middle person, you need to record from the perspective of lessee and from the perspective of lessor at the same time. All right. So the last slide is the disclosure. You learn already how to record the statement of financial position and statement of profit or loss. All right. Okay. Thank you.